Well, hello everybody. Today is November 11, 2011, or 11/11/11, as it's being referred to. And in today's commentary, I'm going to do both a visual like this and then my typical screen capture of a couple key things happening in the market. Now, for those wondering why in my last video that I actually showed my mug in, I was clean shaven and very professional looking, and in this one, I have a very grotesque looking beard. November, as most of us know it, is no different than many months, has Thanksgiving and Veterans Day, of course. But in the last few years, there's been a bit of a movement called Movember, and in that month, men are encouraged to start the month, November 1st, clean shaven, and then by the end of the month have a very manly mustache. So this is my effort at Movember. Now the reason that people do this is to raise both awareness and money for men's health related issues, specifically prostate cancer and other cancers that affect men. So if you just cut me a little bit of slack about that. Other quick note on my nasty beard is that I'm finally starting to get gray hairs in it. So in some of the spots that look patchy, it's not because I have bald spots. It's actually because evidently Father Time is catching up with me and I am getting gray hair on my face. Go figure. So enough about Movember. Other things happening this month, just a recap. This week was a rather interesting week because there was a lot of volatility. The market was to go up significantly, then down significantly, and a lot of that was related to news in Europe, specifically Greece and Italy, and even a little bit yesterday with France. And it seems like each day, if there was any type of bad news out of Europe, the market would fall. Like I think it was Wednesday, the market dropped 370 points. And then there was a little bit more optimism, like yesterday, Thursday, and today, Friday, the market would rally. And at the end of that 3-day period, the market basically finished the week roughly where it started. There wasn't necessarily a big rise or a fall, but I think it's important for investors to note that you could look at your account one day and then look at it the next and see these huge swings if you're 100% fully invested in things like stocks, especially stocks that are based in Europe or financial stocks that might be heavily invested in the bonds of some of these European countries. So I think until there's actually some real clarity, it doesn't make a lot of sense to take a lot of risk because I think, again, you'll have these up days followed by down days, and a lot of it is dictated by news that, of course, none of us can control. As it relates to the news in Europe, just some things that to kind of clear up. I think a couple items worth noting. I mean, one is I've heard people talk about, should the U.S. bail out the European banks and European countries? Well, the odd part is we're in no position to do that. The United States has a massive deficit already, and we have a massive national debt. So I really don't think that conversation should even come up. We don't have the resources unless we borrow them, and all that does is puts us in a position where down the road we may end up a lot like Greece or Italy or Portugal, Spain, Italy, these the countries in Europe that are struggling so much right now. And as far as what it is that they're trying to accomplish, I mean, a lot of the votes that are going on have to do with austerity measures. Essentially, will the leaders of those countries be able to convince the people to cut a lot of their expenses, their government-related expenses? So are they able to push out mandatory retirement dates or the country or government-sponsored retirement dates, their equivalent of what we call Social Security? So far, places like Greece have been very unwilling to do that, whereas Italy appears to be much more willing. It's also worth noting that what's happening in Italy is really far more important than probably what happens in Greece. I mean, Italy is a much larger economy. It's actually a very productive economy. And while it has debt problems, I think that the strength of Italy as an economy gives it a much better position to dig itself out of some of its debt. Now, debt in Italy, at one point this week, a 10-year government bond, so guaranteed by the government of Italy, was paying, I believe, 7%. And that was sort of the same level that Greece needed to get a bailout once their debt got so expensive. Now, Greece's debt, of course, is actually much higher. They have to pay a much higher interest rate. And the interest rates in these countries are directly reflected by how probable it is they'll be able to repay them. So the more fear there is that a country may default, the more likely, of course, they are to have to pay a high interest rate to borrow money. Now, in the United States, it's interesting because for us, a 10-year note, I believe, is about 2.5%. So it doesn't cost us a tremendous amount of money in relative terms compared to Italy. But really, our government is in not much better position. I mean, really, the position that we have that makes us so much more able to keep interest rates very low is that we have a much larger economy. Our gross domestic product is significantly larger as well as more diverse. And on top of that, the US dollar is the world reserve currency, which means that virtually all commodities around the globe are traded in dollars. So everybody has to hold dollars, makes it a lot easier for us to raise capital than if you're part of the European Union. And of course, you're using euros. And then as a government, you're borrowing and you don't have the ability just to print infinitely more euros to pay back the debts you cannot afford. In the United States, at this moment in history, we do have that ability. I'm not certain we'll have it infinitely, but that is what's happening there. One other quick note I thought while I have the more personal version of my blog posts going up. Today is Veterans Day, so I just want to thank all my clients and friends and family who have served. I had myself oftentimes wondered what it would have been like had I enlisted, and that would have been in the mid to late 90s when I would have become of age to do that. And of course, I got into finance and was not able to participate in any one of the United States portions of our military. So whenever Veterans Day comes around, I try to be especially grateful for those that did give those years, in some of these folks' cases, their lives, to defend the freedoms of our country. In my own family, my grandfathers were both veterans, as well as one of my uncles who actually served in Vietnam and was nearly killed by a grenade. And then one of my best friends growing up served for 6 years in the Navy, and right now is using the GI Bill money that he received to finish up his undergraduate degree in biblical studies, and is going on to seminary next year. So I couldn't be more proud of those people I know. I have a lot of clients who also were in the military, and again, just want to say thank you for your sacrifices for the greater good of our country and everyone else's freedoms. So it's enough for today's personal version of this. I'm going to cancel this video out or stop it, and then I'm going to do a couple quick overviews of some charts to show people the key levels that I talked about earlier this week and last, and kind of give some ideas. I think Monday will be an extremely critical day to determine if we're going higher for the rest of the year or going lower again. So I'll be right back. All right, well, I'm back, and in this portion of the video blog update for the end of the week, just wanted to revisit this little chart here that I had put on here a few days ago and shared, and just kind of looking at the last 6 months specifically in the market, and really trying to determine what the future direction is. And as we can see here, market had hit its high for the year, actually all the way back in May. And then it proceeded to drop in the neighborhood of 8 or 9% before then quickly rallying. And when it hit this peak here, which was in the first or second week of July, it actually was just a few points lower than the highest point it hit in May. After that drop, just about a 5 or 6% drop, the market then again quickly rebounded, but still finished again just a percent or so lower than the previous high. After that, we had the large drop for the year. This was the roughly 20% drop that happened starting at the end of July, and then proceeding all the way up until the bottom, which was the very end of September. And from that point, the market has recovered about 2/3 of its losses from its previous high, the high that happened at the end of July. And what's really happened is we've found since that big sell-off, there's been a couple different trading ranges the market's been in. So there's this bottom range that it stayed in for really the better part of a couple of months. Kind of see that better right here. And it finally broke out to the upside after passing through 1220. And I'm looking at the Standard & Poor's 500. After it broke through that range, it's been trading since then anywhere from 1220 up to as high as 1285 or thereabouts. And in the last, really, I'd say 3 weeks, it's hit another high, another peak here. And what you'll notice is that it's kind of on this same general pattern of each one of these highs keeps getting lower and lower. Now, generally, that's a very bad sign. It just means that there's weakness in the market. Despite the rally here in the last couple of months, since the 1st of October, the market is still having a hard time getting back to its highs of the year. And ultimately, you can't start a new long-term bull market, so multi-year bull market, until you've established a new high. The other interesting thing is that these lows that we see here recently, these highs we see on this chart, are actually lower than the highs that were realized in 2007. So we can see that if we actually look at like this monthly version of this chart. We can see again there was a peak here in 2007, and then this most recent peak back this summer, and those are also lower, which again, that's not generally a good sign for the long-term strength in the market. So as far as how that relates to today and what's going to happen going forward, I think as I've drawn in here before, in this yellow box, that seems to be the support and resistance. Support meaning when the market falls, it tends to hit that before bouncing off, but when it goes below it, it tends to come up to it and have a hard time getting through. And we can also see kind of this, what in the technical world they call a wedge pattern forming. I didn't draw the lower end of this line, but it would be basically, if you can see where my cursor is moving across the screen here, that's where that would be. And so much like the trend we were in at this bottom, so as I said, there's been a series of just, ranges. The market goes from a high to a low to a high to a low. Here, we're going to have to either break out higher or break out lower. Now, I mentioned in the first part of the commentary when I was showing everybody, my actual face and clothing and dirty beard and all those things, that I think next Monday will be pretty critical. And part of the reason for that is if we're going to break through this to the upside and get back up to the highs of the year, it has to happen really in the next, I'd say, few days. And I really think Monday is critical because if Monday ends up going down, it might just signal another sort of resuming of this downward trend. However, it can break through, and if the market can get up above 1280, and I've mentioned that there's a range somewhere between 1270 and 1280 that the market has to break through. If it does, I'll be pretty bullish, and I think that the market will move nicely the rest of the year, perhaps up, I don't know, about 10%, but maybe another 6 to 8% to the upside, and that'd be a nice amount of gain to capture if the market goes up higher. However, if it doesn't break through 1280, I'd be shocked if it didn't come back down at least to this same range that it had found its support and resistance at below, which is about 1210. It'd be about a 5% decline or so from where we are right now. That being the case, knowing that all we have to do is have a market go up another 2 or 3% to get to a point where we feel comfortable buying longer term, or if the market doesn't break through that, we're looking at 5% or larger losses. The simple trade-off is that we want to still be conservative. We don't want to try to chase the market's gains because despite how nice Friday and Thursday were, it still only made up about 75% of the losses from Wednesday. And ultimately for the week, the market finished roughly where it started at, despite all of the volatility. I mean, we had 4 of the 5 days, the market moved more than 100 points using the Dow. So those are pretty large moves, and a couple of them were over 250 points. So with all of that volatility, it just doesn't make a lot of sense to go out and get really aggressive trying to chase returns that happened in the last few days to last few weeks, because there should be a very clear trend, I would suspect, emerging very soon. Now, whether that trend is up or down, we don't know quite yet. So when we're still in a range where a lot is unclear, it always makes most sense to be balanced but conservative. Once that trend is made clear, we'll either want to get more invested in the market or further eliminate market securities in effort to protect the assets that we have. So that's the update for this week. Hope everybody had a nice one. Again, thanks to all the veterans out there on this Veterans Day. I know my children might not appreciate it yet. They had school off today. But whenever I get to spend time with my kids in a day where they don't have school, it makes me very grateful for all the freedoms and all the opportunity that we have in this country, a lot of which we would not have if it weren't for the men and women who serve proudly for their country. So again, thanks everybody. Have a wonderful weekend, and I'll be back in touch next week.